All right, annuities. I will first of all, I'm going to tell you what we're not going to talk about. We're not going to talk about annuities that come with your employer sponsors plan. So, for instance, TSP and sometimes 401k, sometimes 403bs, which are for teachers and state employees. They'll come with an option where you accumulate the money on your own instead of taking the pension option. You accumulate the money on your own, and then when you go to retire, you can turn that into an annuity. It's called an immediate annuity, where your lump sum immediately goes to a pension type payout where they'll pay you monthly, and they'll do a calculation based off of your age, based off of actuary tables, and they'll say, okay, for your 100,000, we'll give you $150 a month for life, or they'll tell you we'll give you $300 a month for 10 years, which is called a period certain annuity. We're not talking about those because those are very straightforward. These ones, the reason I did this one is because annuities are very popular if you go to a financial advisor, and they're very, some of them can be very complicated. And your friends, or as soon as you get an annuity, your friends or another financial advisor say, oh my God, they suckered you into annuity. Well, that's not the case anymore. Hopefully, that's not the case anymore. But they are very niche products, and you have to be aware of their usage, or they just won't work for you. All right, let's go. So, annuity is short for annuity contract. It's not an investment per se. What it is a contract between you and an insurance company. Um, and all they do is they protect against what's called longevity risk. Longevity risk is that you run out of money, essentially. So they will guarantee you. They'll put in guarantees, and there's so many guarantees that you could add and subtract from annuity contracts, and we'll get into those. But like I said, primarily you turn your money over to an insurance company, and they will guarantee a certain level of income, sometimes a certain death benefit. Uh, they'll protect you against market losses. Sometimes they'll take some losses, but not all the losses. Um, so it's just based off of what bells and whistles you want to add to the annuity contract. We'll go through all those, but basically it's between you and an insurance company. It is not per se an investment. There's investments inside of it, but you have to know that it is insurance contract, just like a life insurance contract, just like a contract for auto insurance. You're protecting against the risk. So don't go into it thinking, hey, I got this great investment, I got an annuity. That doesn't tell me anything. That's like saying I got this great investment, it's called an IRA. And that's just a tax blanket. It doesn't tell me what you're actually invested in. So same thing here. Annuity contract is insurance. Okay, don't let anybody fool you on what it is. Um, and like I said, it's primarily to protect against longevity risk, is you running out of money. Believe it or not, you could accumulate all the money in the world, and if you don't withdraw it correctly, you will run out of money. It doesn't matter how much you have. If you don't withdraw it correctly, you will run out of money. I should probably do a retirement withdrawal strategy class. Like I said, I think I covered this in another class. If you uh, ran Monte Carlo simulations on your money, and you said, let's say it's in a balanced mutual fund portfolio, and you have 200,000, and you have losses at the very beginning, and you're withdrawing, it will probably cut off 10 years off the back end, just from that 1 year of losses, and you're withdrawing. Let's say you get 5 years of no losses, and you're withdrawing. That will probably extend it 15 years. So, what you do when you're withdrawing is incredibly important, and it's way more important than saving, because you can actually just throw money into whatever, and it most likely will accumulate for you. It's really easy if once you're disciplined to save and it grows for you. You could be the most disciplined person in the world if you withdraw incorrectly. Like I said, it will be devastating, and that's what annuity contracts protect against. Um, they also protect against your you using all of your money and having nothing for beneficiaries. Protects against that as well. And so you could get enhanced death benefits on them. You could get long term care on them, which, if anybody knows about long term care or has a parent that went into long term care, very, very expensive. An annuity will guard against that as well. So they are very good in certain instances. And again, they will protect against downside. They sound really good so far, but it's an insurance contract. So you have to pay for those features. They're not just going to cover your car for free. They're not just going to cover your house for free. They're going to make certain calculations. They're going to give you what it costs for that certain uh, for that benefit, and then you pay that as part of your contract fees, and that's regardless of the investment. Okay, so let's get into it. First, what is your responsibility as a client in this transaction? Well, obviously, you have to fund it. They're not going to give you something for nothing. And sometimes people think annuities are something for nothing because the way they're presented is a lot of times is if you put $500 a month in, I can guarantee you, you know, $1,000 a month in retirement. Sounds like a great deal, right? But there are a lot of stipulations in there. One, obviously, is the funding, if it's funded correctly. Two, what kind of returns are you getting? Three, what kind of protections are in there? So even though they present it a certain way, your responsibility is always going to be funding, and it's always going to be doing your due diligence. So there's two ways to fund these. Like I talked about at the very beginning, you could do a lump sum and turn it into an annuity. You can do a lump sum and then it grows based on the investment. You could do a lump sum and then do payments along the way or several lump sums. You could do monthly payments, which is usually the most common, is the monthly payments because you're putting away money that will not lose value. So if you start them early, just like any other investment, they can grow and they can lock in some pretty significant benefits. Like I said, if you go into them with your eyes open. So again, funding is very important. Like I said, the way they sometimes position them is if you give me so much a month, I can guarantee you X, Y, and Z. Um, and sometimes people say, okay, $500 a month, that's fine. But 20 years pass, a lot of stuff could happen in 20 years. $500 may seem like a little now, and you could get into trouble, and then it all goes downhill. Um, so, lump sums. The people that put in lump sums are typically people who have problems with income. And not just we have we don't have enough income, which is obviously a problem for a lot of us, but it's they have too much cash and no income. So I don't know if anybody's been in this situation. That can be incredibly difficult to manage. Is cash flow can be if you have too much cash flow and no like income per se, like let's say NFL players, massive amounts of money on the front end, and then we all see them getting arrested, 5 years after they leave the NFL because they just didn't manage their cash correctly. A lot of small business owners, this happens to, because they don't rely on Social Security because they put in so little into Social Security that they're not going to get back very much. Their calculations for Social Security is much different than ours, and they're not going to get much back. So they may have a huge lump sum of money, and they may be, thinking, I can buy all this stuff, but at some point I gotta sell my business, or some point I gotta stop this business. I'm a mechanic. I got, my body's breaking down on me. I may have a large sum of money, but it's not gonna last me until I'm 90. I have back injury at 50. That is a significant problem for some people. Um, Annuities. That's an example of somebody who would do a lump sum annuity. They don't have a pension, they don't have disability, they don't even have Social Security, they don't even have a steady income. It's just sales is what they're getting. You guys ever see those drug money movies, like Breaking Bad, stuff like that? They just have stacks of cash everywhere, right? And their problem is they can't use it. They just can't use it the way it is, and some people have that problem. Um, all right. Second one is grandma. Grandma has a lot of money, and she doesn't want to start writing people checks. She doesn't want to, sell her assets. She doesn't want to, just give away everything she's gotten to people that, one, either didn't earn it, don't deserve it, or just spendthrifts, stuff like that. So what she can do is she can set it up a annuity for each kid or each beneficiary, pay them a steady income, for the rest of their life or for a certain period of time, and that way she could kind of control how the money is dispersed, who it's dispersed to, instead of relying on a probate court, relying on a will. It's not a lot of times legally binding. Contracts are legally binding. They are with an insurance company. Um, they're guaranteed to grow at a certain rate, and they're guaranteed for income. So if you're a grandma or something like that, and you sit down and you say, you know what, I have significant amount of assets, and I have these, three children that are 2 years old. I'm not going to start, giving them hundreds of thousands of dollars and hope that it goes correctly. That could also be a disaster. Like I said, I've seen a lot of problems as a financial advisor, and you wouldn't think that people have these problems, but they are sometimes very significant problems that some of us would be very happy to have. Uh, Single parents, not single parents, stay-at-home parents. Stay-at-home parents don't have retirement plans. Okay, my brother is a Fed, and he's like a GS 13 or something ridiculous, and his wife is a stay-at-home wife. Um, he opened an annuity for her on her behalf, so if something ever happened to him, then he doesn't have to pay a large portion of his pension to ensure that she has that income. Because a lot of times when you're paying into a pension and you go to cash it out, they'll charge you 40%, 30% of your pension just to cover your spouse, and it's not guaranteed that your spouse will even ever receive it. Because if your spouse dies before you, a lot of the stipulations say you can't pass on your pension to anybody else but your spouse. So you just pay 30, 40% of your pension for no reason at all. Um, and again, that's what I'm here for, is to look at some of these and to see where these investments fit. And so he put together an annuity for her. He puts in what he would put into um, a retirement account for her, or something like that. And instead of being restricted to retirement laws, then it's a little more flexible. It grows a little better. Like I said, it's kind of a set it and forget it because of the guarantees that are built in. So again, these are really, really good for um, uh, stay-at-home parents or parents that have a large discrepancy in income. So you have somebody that makes 160,000, you have somebody that makes 40,000, and you want to make sure that the standard of living for the person with the 40,000 doesn't drop significantly. Then you can do an annuity. Again, it's with the life insurance company. So a lot of people, they say, you know what, I can't get a life insurance policy. I'm just not healthy enough, or um, something of that nature. And then they could do an annuity as an alternative, and instead of getting a lump sum payout, then they may get payments, And also, if you have a stepped up death benefit, and we'll talk about what that is, then you don't need life insurance because you're self funding your life insurance and it's guaranteed to pay out through an insurance company. And you don't have to take that health screening, you just have to fund it properly, and it'll lock in uh, the death benefits for your spouse. That's another way to protect your your family without having life insurance, traditional life insurance. Let's see. Another one is kids. Like I said, you don't want to open a retirement account per se for kids. It's hard to use them when you need them because you have to wait till 59 and a half, and the investments a lot of times will be fluctuate with the market. There's no guarantees on them. You can open a custodial account, but then the kid owns the money, and then you're just the custodian, and you really, once they turn of age, it's very hard to make them realize that the benefits of the money and the benefits of it growing. So you can do a annuity for kids, and it grows, and it locks in a lot of those benefits, and they can take a stream of income at a later date. And like I said, it's very good for these type people. So when you're going to funding, realize that there's different ways to fund it. There's different outcomes based on how you fund it, and you have to be diligent in terms of funding them. All right. So again, your responsibility is also the risk to return. In my investment class, then we talked about what's the appropriate level of risk versus your possible return. Now, this one is a little more tricky because if you pay for guarantees, then you can significantly push the risk factor higher so you can lock in better guarantees. And I'll show you how that works towards the end of the class. But if you have ultra conservative investment, then you have guarantees that are linked to that investment, it's not going to perform as well because they're not guaranteeing very much. They're guaranteeing a very conservative investment, which kind of defeats the purpose of having guarantees. But we'll get into that a little later. So there's three basic types of annuities. There's fixed annuities, there's fixed index annuities, and there's variable annuities. Now, this right now I'm only talking about your cash. I'm talking about what money you put into it. I'm not talking about guarantees right now. Okay? I'm talking about just money that you put in. So you put in $100,000, that's what we're talking about. We're not talking about anything the insurance company is doing right now. Okay? So, when you put in your money, it's got to go into an investment even though you're in an insurance contract. So we're just going to talk about investments for a second. Fixed annuity is a fixed rate based off of treasuries and based off of how long you put it in there. If you put it in there for 2 years, obviously you're not going to get as good an interest rate if you put it in for 6. Think of this as like a CD. They give you an interest rate up front. You agree to it, don't agree to it, and then you have to lock in your money for a certain amount of time. No risk to principal here. But you do have what's called an opportunity cost, meaning since you can't get to that money, you may be losing out on skyrocketing interest rates, because remember, you're locked into this interest rate. Interest rates go up, you can't take advantage of that. If we're in a bull market, again, you can't access this money to go invest it. You just have to wait and see and get your money back at the end of the term. Okay? Fixed index annuity, this is linked to an index, as it says in the name. There's no risk to principal. You will take a certain percentage of the highs or the gains, and you will take none of the losses. So this is linked to an index. These are pretty powerful, but since there's no risk to your principal, these can be sold by a much lower licensed financial advisor. So beware that if somebody is only giving you fixed annuity options, That means that they don't have the licenses to give you other options, which could be a hindrance to you reaching your goals. So you can these are very good, but they have to be presented um, in as an option with other options. Okay, because you don't want to be just have a financial advisor that can only do these products. You want a financial advisor that can pick and choose which products can help you meet your goals. So these sometimes are a red flag because you only need an insurance license because these are insurance projects. You only need an insurance license to sell these, even though there's investments inside. Okay, no loss to principal, which means they don't have to have an investment license. So take that into consideration. Uh, Variable annuity. This is based on the performance of what's called a sub accounts. It says stocks and bonds. Does it say stock and bonds? No, that's on another slide. But these are most likely mutual funds. They're usually very, very, very popular mutual funds. They only they only partner with the some of the best mutual funds, best well-known mutual funds, because that's a selling point. You can say, you know what, I can lock in the gains of this great mutual fund, and you don't have to take the downside of these great mutual funds. That is a very powerful way to sell these products. Is you have access to these mutual funds at one a lower cost because they negotiated these costs, and two they could be very very good mutual funds, lower cost, and you get to lock in the gains. I mean that a lot of times that just that alone is a slam dunk for people selling these investments. And it also is good for the mutual fund company because the mutual fund company gets to negotiate who's on the contract or who's able to invest. So if you are American funds and your biggest competitor is, let's say, Prudential, you say, you know what, I'm going to partner with this insurance company to provide American funds in this annuity. I don't want you to hire, I don't want Prudential funds available in there. You could do that. The mutual fund companies can do that. They can make deals with the insurance company to not carry other funds and to only carry theirs, which means they get more money invested into their mutual funds. So it's kind of beneficial for both powerful mutual funds and the mutual fund companies get kind of corner that annuity market per se. So that's just a quick overview. Now we're going to get into these in depth. We're going to talk about what your cash account is. This is what you were able to withdraw all at once. Okay? So you put in annuity money. We're not talking about guarantees. We're just talking about the investment and what you're able to pull out. Let's say if you don't want it anymore or if you have completed your term of the contract. Okay? So, fixed annuities. Okay? Your interest rate is known in advance. Known in advance. You go in 4% guaranteed for 60 months or whatever it is. Okay? No loss to principal. Fixed term, fixed interest rate. Think of these like CDs. The goal of these is at the end of the term, you got your interest rate, you have your money back, it's free and clear. You you most likely have to do something with that money now. Okay, you can annuitize it. Annuitize it means turn it into payments. But most people that I've seen that use these or use them solely for a lump sum as an alternative to CDs, as an alternative to fixed income bond type portfolios. And so they're expecting they put in 100,000, they're expecting at the end of 4 years to get 110,000. That they can plan on that. They can it's binding in the contract. They can write that on their in their spreadsheet. They like to do that. The people that use these like to know how much they're going to have 4 years from now, 8 years from now. So the sum of these, the goal of these really isn't to get income or any type of guarantees. The guarantees are built into the fixed rate or the interest rate. Again, why would you try and lock in high gains when Why would you pay for that kind of benefit when you're at a very, very conservative investment anyways? So that's kind of like paying for the same benefit, if that makes sense. And I'll get it, and I'll contrast that with another type in a second. Pros of this, very predictable. They keep control of the cash. So I give you cash, you give me back cash with interest. Pretty simple. No loss to principal. Again, I said it right there. Very simple. People can understand these. Again, they're like CDs. These are tax deferred. So the growth is tax deferred. You don't pay it until you actually pull out the cash. You can have an IRA in an annuity. I wouldn't recommend it because that, again, IRAs are tax deferred, so are these. So it's the same benefit, and there's really no gains that you get from putting an IRA into an annuity because the annuity's tax deferred anyways. So this is a way to get the tax deferred benefit without the restrictions of traditional IRA. Let's cons, very, very, very limited upside. Uh, there's typically no income benefit because income benefits are expensive, and you're only making 3, 4, 5%, and an income benefit could cost you 1%. Same with the death benefit. Death benefit could cost you 0.5%, 1%, whatever that is, and that will directly affect your interest rate. Because if you're only getting 4% and you're paying 2% in fees for the insurance contract, that is not a very good investment at all. So if you are getting in the market for a fixed annuity and people start adding bells and whistles to it, it's not going to turn out well for you. Again, rollovers, in order to keep that tax deferral, you have to put it into another annuity. So every couple years, you have to go search for good interest rates again, just like CD rates. 6 months have passed on a CD rate, you have to go shopping for another CD. And then 6 months later, you have to go shopping for another CD. I would have 90-year-old people CD shopping at 5 banks. I mean, it's crazy, but that's their hobby, and some of us that's a pain in the butt. So you have to keep it in the annuity form and keep rolling it over like an IRA, or the gains will be taxed. So that's one of the cons of fixed annuities. Let's go to fixed index annuities. Fixed index annuities are like fixed annuities, but you get to link your investment instead of a fixed amount or a fixed interest rate. You get to link it to some kind of index, like the S&P 500, like the Nasdaq, like the Russell 2000, but there is no loss to principal. You don't take the market declines. In exchange for that, they may give you only so much of the upside. It may be capped. So they may say, okay, we'll give you the S&P 500 up to 6% gains. But you won't take any losses. So you will make every year guaranteed between 0 and 6. Okay? Or 0 and 8. I've seen them go to 12, maybe. I've seen them as high as 12. They're calculated a little different, but I've seen them the caps on these pretty high. So that's how they get paid on these, is if they do really well, then they cap you, and then they make up the difference. That's how they make their money. And then in exchange for that, then they'll give you max downside protection. So rest assured, they're always going to make that money, and you want to know how they're doing it before you enter into one of these contracts. These terms can be fixed as well. So you can go in and you say, oh, okay, I only want to do this for 6 years. And they'll do it for those. Again, your lump sum at the end of the term, you'll have a lump sum, but you'll also have the option to annuitize. This one, because it has some upside potential, then you can opt into some benefits with these. You could opt into a higher death benefit. You could opt into some guarantees on the income side, and then you're able to turn this into lump sum, turn it into payments, or you can just take the lump sum. So they're very, very flexible. You keep some control because you can opt into the benefits or opt out of the benefits. Again, no loss of principal tax deferral. Um, some of the cons of these is they limit your upside potential. You can get zero. So if the S&P 500 is down, you could post a zero. What we say in the industry is typically for every 4 up years, there's one down year. So if somebody's in a 5-year contract, I tell them at least anticipate 1 0. At least 1 0. Okay. Um, and if you are averaging the returns, it'll probably still be better than a regular fixed annuity. These can be complex. How they calculate your index isn't straightforward. It doesn't say the S&P 500 return this for the year and we'll give you this. No, a lot of them are by months. A lot of them are based on how much money flows into those, how many annuities they sold. So they come up with their own type algorithm of how they invest it and how they calculate the returns, but it is pretty close to what the index is doing. And they can't go by the index specifically or 100% because of that downside protection. If if the market's down 10% in 1 month, how are they guaranteeing zero? Guaranteeing you zero when the market's down 10%. That's because of how they're structuring these investments to follow some of the upside and then protect on the downside. So looking at your statement, you may be confused on how did the S&P was up this year, how did they come up with this? So there are a little more complex, and you have to read the fine print to figure out how they actually credited the interest. This one you have to roll over as well. So if you opt into lump sums, you do have to roll over every year. What's better about these is you don't actually have to roll over if you don't want to. So think about it. If I guarantee you 4% interest, like on the last one, fixed annuity, I have to go searching for better interest after that guarantee period. Whereas on this one, if I go in the S&P 500 and I say, you know what, the S&P 500 didn't do very well, the Russell, I think that's going to be better. Instead of just, you know, withdrawing it, putting it in another account, you could just say, you know what, instead of going to the S&P 500, I'll switch it to the Russell. And then you have essentially a new contract with a different type of investment inside of it. Again, this one's a little more flexible. All right, we're going to spend the majority of our time on variable annuities, and this is because these are the most complex. They're also the most popular. These can be very, very good accounts, but you have to use them correctly. And the other two were very straightforward. I think you can figure those out. If you do have a statement, I could go over that with you. But I'm going to go over a statement of variable annuity just so people know what that looks like. So, interest based on the performance of sub-accounts, basically mutual funds that are only for that contract. A lot of times they're institutional shares, which means they don't pay typical mutual fund fees, and that's good for the purchaser of the annuity. Is they have access to, like I said, better investments without the fees typically associated with them. You do have risk of loss, but this is only in the cash side that you put in. I'm going to talk about the guarantee side in a second. This variable annuities are unique where they have two columns. They have what's guaranteed and they have what your cash is doing, whereas the other ones may not have that feature. Okay, and there's a reason for that. This term is open-ended, typically open-ended. There's no expiration. There's no fixed period. What they say is, okay, you could have this as long as you want. Typically up to like 80 or something. They cut it off where you can put in money. But they'll say, okay, you can't withdraw, or we'll penalize you for withdrawing after like 9 years. After the 9 years, you could take your lump sum without any penalty, and it's open ended, you know, for forever if you wanted to. Um, so this one's different in terms of the type of the length of the contract. This one is designed for lifetime income. Even if you wanted to take your lump sum, and even though if your lump sum did very, very well, I will guarantee you that the lifetime income looks a lot better than what you would withdraw. If you think about, let's say, the lottery says, I could give you this today, or I could give you this for life. And one of them is usually much, much better than the other one if you were to calculate it. Same here, the income option, depending on when you take the income, is going to be a lot better. And I'll show you how they do that. So this one, you want your goal to be lifetime income. If your goal is to get a lump sum at the end, you're paying for guarantees for no reason. You should go into an index or a fixed index if you want protection against market loss. These should be only used for the lifetime income. Now, there are some variable annuities that are called investment only annuities. And there's one company that I don't want to say that does these, and they're very frustrating because they lock up people's money just to invest in lower fee mutual fund, which doesn't make any sense. Why would I give you money for 9 years just so you can give me a 0.5%, you know, 0.5% deal on the fees? But they do it, and they like to do it, and I've seen a few of them, and they suck. So, anyways, pros: semi-flexible. You can have your lump sum if you want it. You may not want it once you look at the benefits. Uncapped upside. You can go as high as the mutual funds will take you. Okay, these typically have income, incredible income benefits, great death benefits, and these are also tax deferred. And like I said at the beginning, you're going to pay for these. But with that uncapped upside, that will kind of alleviate some of the cost. And I'll show you that in a second. The cons of these, you could lose money. You could lose zero. I don't know why I put that. This is late at night. You could lose money on your principal side, which means you could lose money if you go in and you say, I want all of my money back. I don't want your dumb income benefits. I don't want your all that other guarantees. I just want my money. I need it. You could have less than you put in. That's very, very possible, and that's because of the fees are coming out of the cash, and that's because of the performance of the mutual funds. You have very limited control, meaning that you could change investments, but you lose control essentially of the principle of what you put in because the benefits are so good, and they're taking everything from your cash, guaranteeing you some stuff, but in order to get that guarantees, you have to essentially not see your principal ever again. So the people that I kind of advise do these, I say only look at the benefits that you're paying for. Don't look at your cash because it's now meaningless, right? Think about it. If you have a pension with the government, does the government know? Do you know how much you put into the pension? I think it's somewhere on your LES, maybe. The Social Security tell you how much you put in over your lifetime? No. You could have 600,000 sitting at Social Security, and you don't have a lump sum option to take it, so it doesn't even matter. What matters is your monthly income. And so I tell people, look at that the same way as you would Social Security. Okay? Even though you put in this money, that money is used for the income. That money is not used as a piggy bank that you can withdraw. You have to go into these contracts thinking exactly like that, thinking this is a Social Security type account, because essentially that's what it's being used for. All right, here's the structure. So it'll have 2 columns, sometimes 3 columns. This is your cash balance and investment performance. You'll have what your cash is doing, just like a mutual fund. Okay, you have 50,000, you gain 3.5%. Now you got 51.7. Okay, and down the line, right there you lost 2.5%. Okay, now your money went down. Now you have 53,140. Okay, and this if it's out of surrenders, so if they don't penalize you for taking this money, you could go in and say, you know what, 53,000. I want you to write me a check for 53,000 right now. Okay, or when it made 6.7, if it's no longer surrender charges, like I said, those stay on anywhere from 7 to 12 years. No more surrender charges. You can say, write me a check for that right now, and they'll do it. So you have some flexibility. But then look at your other column. This is the guaranteed column. So you'll have a column that says this is what your money is doing. This is what our guarantees are doing. They're not the same. Okay? So this is called the income benefit base with a 5% roll up for 10 years. So what this means is they will guarantee you 5% or whatever the market did, and add that to your guaranteed balance, your income benefit. These you cannot withdraw. Okay? Everything in the blue you cannot withdraw. This is what your income is based off of. Okay? So you got 15 or 50,000, you made 555. These are the guarantees, and that's because the market made 3.5, 4.25, and negative 2.5. So they locked in your benefit base at 5%. So when your withdrawal, when you could only withdraw 57,000 or 53,000, if you were to turn on income, it would be based off 57,000, because your guarantees did better than the mutual funds because of this guarantee. Okay, it made the 8.5 because that's higher than the 5. It made the 6.7 because that's higher than the 5. So now your income base is based off of 67,000, whereas if you withdrew a lump sum, it would only be 61. These, like I said, you can't withdraw the 67. You can only withdraw the 61. This is only 6 years. Imagine what it would do over 20 years, how big this difference is going to be over a span of 20 years, or even the surrender period, which is 9 to 10 years. After 9 to 10 years, these numbers could be very, very different from each other. And so just after these couple years, you're basically losing 6,000 in benefits, or 5,500 in benefits. You may have a third column, which this one is called a death benefit with a step up step up until income. So until you withdraw, the death benefit will hit the high watermarks of not this account, because this is a separate guarantee. This is an income guarantee. Your death benefit will hit the high watermarks of whatever your mutual funds did. So it locked in the 3.5. It locked in the 4.25. It went up 0 because it already locked in this 53,000. Can't go below that on the death benefit. Locked in the 8.5, locked in the 6.7. So if you were to withdraw it in this bad year, you would get more in the death benefit than you would withdraw. But it started to even out because of these huge gains. And so by year 6, these were both the same, which that's the way it happens. What it's doing is it's locking in the highest balance that your mutual fund ever got. Now, if it never gets back to 61, if this keeps falling and falling and it goes back down to 50, this death benefit will stay at 61. This income benefit will keep it unlocking this 5%. Okay? And what does that look like? Well, so I wanted to show you these 3. This is where they start to diverge. This one is when there's down markets or when it makes very little, income benefit looks like a rock star. Okay, when the market is has zero, then this will lock in the last high that it had. So they're very good benefits um, if you put them on there. Now they don't tell you this on your statement, but this would be your lump sum payout. This would be what your income is based off of, and this is an example. So if you were to take, you could take 61,000 in a check right now, or if you turned on income, it'd probably be around $307 for the rest of your life, and that's based off the 67. Okay, so this is a very real scenario for these annuities. If something were to happen to you, then this would be the amount they got in the corresponding year. So if something happened to you year 4, they would get this 53.9 instead of 53.1. If they if you passed year 6, you would get the 61, or you could have withdrawn the 61, prior to passing. All right, and let's see, what does this look like? Where's my so let's go with terminology. Now this is the last part. We're just going to finish up here. This is terminology. This is the different kind of annuities. You could do deferred. Now what I covered is just deferred annuities, which means you're delaying your benefits until sometime in the future. You're not taking income now, you're taking it in the future. Immediate annuities is like what is offered by your employer. You can take your lump sum 401k, lump sum TSP, start getting income tomorrow. Okay. RILA is just indexed with buffers. This means that they will take some of the losses, but not all of the losses, but they will give you most of the upside. So they're a special kind of index fixed annuity where it does have some downside protection, but not zero. Again, these are for a little more aggressive people, and these are out there. If you have one of these, then I'm very familiar with those. But conservative investors really don't do those. Your standard variable, which I just covered, this says stocks and bonds, but they're going to be mutual funds. A lot of times they do have a fixed option, but why go with the fixed option when you're trying to hit the high water marks? You're trying to outperform the benefits, so they lock in. Okay, here's a different kind of benefits that you could bells and whistles that you could put on these. This is called a GMWB, which is a lifetime 5% a year for life. You can withdraw, and that's guaranteed. You don't have to annuitize. You don't have to turn over your lump sum in order to get this benefit. You could have the lump sum there and just withdraw 5% a year off of it. Okay. The GMIB is the one I showed you where it will lock in certain amounts and then guarantee an income stream for the rest of your life. It's different than a withdrawal. Okay, it's income versus a withdrawal. So these are two different ones, and they usually don't have both. You have to pick or choose one. Do you want to be able to withdraw a little more control, up to 5% a year, or do you want us to just pay you 5% for the rest of your life? Death benefit. This is you could get regular whatever the cash is, or you could pay for what's called a stepped up benefit, which I was in the illustration. You could also pay for COLA. So if you are going to live for 30 years and you're only going to make $1,000, then you may want to purchase the COLA rider, which says that $1,000 will go up based off the cost of living or inflation. So that way, 20 years from now, I'm not getting that same $1,000. It's going to be stepped up based on the consumer price index. Long-term care, you could add long-term care for these. A lot of times they will give you a better multiple. So if you add long-term care to your annuity, let's say you're getting $2,000 a month in this illustration. If you go into a long-term care facility, instead of paying you 2, they may pay you 4,000. they have some benefits that will pay you, 150%. So instead of 4,000, it'll pay you 3,500. Sometimes on these long-term care, you can take your full lump sum out without any penalties. So they have different long-term care riders on these, and they get very, very creative with some of them. So there may be some people out there that say, I don't have that benefit, or this is how it's structured now. Well, it's just something new an insurance company came out with, that insurance companies are always coming out with something new. All right. This is an example that I pulled. This is a real example. This is from 6/30/2025. Okay, so it's just a couple months ago. So let's break this down. That right there is your benefit base. It says right there, no cash value. So if you were to take a lump sum, this 59,000 would not be on the table. This is your benefit base. If you said turn on my income, they would use this to multiply your income. So let's say it's 5.5%, then it'd be 5.5% off this value. Okay, this is the guaranteed value. This is a 9-year lock, which means it will lock in gains for 9 years, and then it just goes by what the high watermarks of whatever your cash is doing. If your cash makes 5%, then this will make 5%. But it's guaranteed to grow for 9 years. Okay, I believe this is in year 7 or 8. All right, if you were to withdraw, you would get a check for $49,387. That's a difference of $10,000. Now, if you're looking at a return over, let's say this is a 7-year contract, over 7 years, a $10,000 difference in return is a large number. So if you put this in for 7 years and you got 59,000, obviously that's a lot better than 49,000. Okay, so you have this person, if they wanted to withdraw, I'd call them in. I say, listen, you paid for these guarantees. They delivered on the guarantees. Okay, you got 59,000. That's what you've been paying for, and it's there. Your cash only made 49,000. What do you really want to withdraw and give up all those benefits that you paid for? A lot of times they'll say no. And then you will also see here, it can guarantee you a lock-in. So this says you will at least make 2,834 because you're still in this lock period. So it's guaranteed to make another 2,800 next year, which would mean that I can guarantee by next year you'll have 62,000 in a benefit base, whereas this you may have 47,000 next year. This is guaranteed to grow. It's not. That's why you pay for the guarantees. Okay. I think I have prices for the guarantees. Here's what it looks like if I were to show you in a table. Or illustration. A lot of times this will have the illustration in it. A traditional mutual fund would do this. If you're in the same mutual fund inside of an annuity with some kind of benefit that you paid for, it will lock in the high gains, and it will even guarantee you a certain amount if it doesn't show these gains. So like this one guarantees, I believe, a 6% roll up. So if the market doesn't do 6%, it will give you the guaranteed 6%, or it'll give you the highs of whatever the market did. Okay, that's in the illustration I showed you, and this is what it looks like in, and it shows here that the sub account or the mutual funds never recovered. That's possible, especially when you're paying for these benefits. Now, each one of these benefits, let's go back. Each one of these benefits could cost you anywhere from 0.5% to 1% each. Okay, so you have to be very careful on what you're adding to these and if you're actually going to use them or not. Okay, if your daughter says she'll take you into her house and she's got a nice mother-in-law suite, really no reason to use your long-term get a long-term care rider, especially if they have multiple riders and they just get more expensive. There are some that are like 1.5%. So let's say you got this GMIB, guaranteed minimum income benefit, and they'll sell you, you can get 5% if you pay, let's say, 0.75% a year to get this 5%. They may have another option where they say, we'll guarantee you 6%. You just have to pay 0.25% more per year for that. Weigh your options, see if that's something you want to pay for. Like I said, they can add some crazy bells and whistles on these that will really put a number on your cash value. A lot of this 10,000 could have been just in fees. Over 7 years, that's a lot of fees, but it's